Hello traders, Gary Wagner here at just about 12:15 in Honolulu, 5:15 in New York. It is Thursday, January 23rd, 2020, and this is the daily report for gold and silver. We had a moderate gain in gold today. In fact, the precious metals, with the exception of platinum, did well today. On today's report, what I want to cover is a modified or more complete projection of how I think this correction will unfold in terms of where it's going to go. I believe we're currently in the B wave and where the C wave could go. I'll also discuss how we can differentiate between whether or not this model is actually the one that's going to unfold as opposed to a triangle compression. But first, let's take a look at current pricing. A quick correction. Both platinum and silver did close lower on the day. That being said, gold did close up $5.40 at $1562.10. Platinum did close lower on the day, down $13.80, $1,007.50. Palladium closed higher today, a gain of about $30, $2365.80. And lastly, silver did close lower, down about 4 cents, $17.79, and that was all with some headwinds behind a stronger U.S. dollar, up about 0.2% at 97.49.5. Let's take a look at our current technical studies. Before I begin my analysis today, we did receive a question from one of our subscribers, a David W. from Alaska. I've just put it up on the screen, but in essence, what he is asking is, why are we using the high that was achieved at 1613 when it was, as he puts it, an aberration due to a fundamental spike caused by Trump and Iran's crisis, and why we would use that for the calculation? The reason we use that in our calculation is that it is a true price. Now, granted, the market moved up very quickly and came down just as quickly as the fundamentals changed. If it was an incorrect tick, in other words, a price that was incorrect, or if it was a print due to a single trader attempting to manipulate the market, then I would consider taking it out of the analysis itself. But the fact of the matter is, when you use Elliott wave or Fibonacci, the principles themselves define using the prices that it goes to, regardless of the causation of that price move. And it is for that reason that I am actively and will continue to use 1613 as the high of the year, as well as using it in terms of Fibonacci retracements as well as extensions. David, I hope that answers your question. Now, what I want to discuss is my updated model of how this correction could unfold now that we have some more data points in. And the data points that I'm speaking about specifically is this minor climb up from the lows that tells me that this A wave has probably been completed. Now, the basic tenet behind a simple model of an ABC correction is that first, of course, the A wave, just as wave 1, is really the defining factor in terms of projecting a B and a C. So I'm looking at this A wave as moving from 1613 to about 1536. The fact that it began to trade higher, that tells me that we're most likely in a B wave. However, this could be part of an A wave, which would simply contain 3 waves total, but right now I'm not looking at that as the way this is unfolding. That being said, with the A wave completed, and if that's the case, we are now in a B wave, and typically what you look for is for the B wave to go anywhere between 50% and 75%, the price range that we saw happen in A. If it goes 50%, that would take this current rally up to about 1576. And if in fact it goes up to 75% of the leg down, it would take it to about 1595. Now, this is a rough calculation, and the way you want to look at it is not so much that it's going to stop either at 50 or 75, but somewhere within this price band that I've just put up is where we would look for the B wave to terminate. Given that that occurs, what we would then want to see is how the retracement or corrective wave, that C wave, follows. And the way I've charted it is we've gone way past the 38% retracement already. So if it retraces 50%, that would take the conclusion of this to about 1532. If it was a very deep correction going to a 61% retracement, then we'd look for about 1513. Now, there's a caveat to this, and that caveat is that we could still see this form into a compression triangle of some sort. And the way we would view that and look at that is, let's assume that this particular wave up, what we're calling a B wave, terminates at a price between 1576 and 1595. We would then look to see how the corrective wave unfolds. It is still possible that a compression triangle would be how this model basically unfolds. I have just put up an illustration directly from Elliott Wave's Masterworks in which he labels 6 common types of corrective patterns. You can see that one of them is a triangle, but any one of these could determine or could be the model that actually is used to calculate where pricing will go. As we get more data, we'll be able to determine which one is most likely. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.